For years now, locked-in low mortgage rates and a strong job market have supported consumer spending. But the economic foundation is shifting. Credit stress is rising among younger Americans. Tariff proposals could cost households over something like $2,000 annually, and middle-income shoppers are showing new price sensitivity. So how might this consumer transformation reshape markets over the next decade? We're going to break that down for you and more right here on UBS Trending. Hi again, everyone. It's Anthony Pastore. Thank you so much for joining me for this next episode of UBS Trending. In the studio with me for this discussion today is Bill Sterling, Global Strategist from GW&K Investment Management. Bill, nice to have you back. Good time to be here with everything going on in the markets. There's no shortage of things for us to chat about. Good to have you.
If you're not confused, you're not paying attention. That's what's happening now.
I think that might make people feel a little bit better about the general confusion they do kind of feel at this point in the story. But yes, that's exactly a good way to start it. You know, I want to sort of kick off with you. As we sit here, the headlines are changing. There's tariffs coming in, then there's tariffs going out, and then they're putting pauses. So we can get into the specifics, but by the time somebody watches this, it could all be different. But where we sit right now, we've got a strong job market. We've got these locked-in low rates. I'm one of the lucky ones who refinanced my mortgage a few years back, and I've locked in at a low rate, and I'm hoping not to have to move anytime soon because it's very, very attractive. But it supports consumer spending, as you write about, but there's rising credit card delinquencies, and some of our younger Americans and shoppers are having defaults on their auto loans. What are you seeing here, taking a look in between the lines, between the people like us who have the longer mortgage rates that are locked in and the younger folks who are getting these loans in the last 2 years while rates have been high?
Well, I think it was clear even before this current tariff tantrum that there's a downshifting going on in the pace of consumer spending. We've had a couple of really strong years in consumer spending, supported by some of those factors I mentioned. But when we kind of look under the hood, we really see a two-speed economy, because even today, Bloomberg had a story that car loan defaults are at their highest pace in 30 years. So I think we have a big number. Yeah, and I think that so there's stress under the surface, and it's particularly among lower-income households and younger households that didn't benefit as much from the huge wealth effect of since 2019, stock prices are up 84%. Housing prices are up like 53%. So people who owned assets, which tend to be the higher income households, benefited tremendously from that. But if you weren't part of that game, you didn't. And you also were hit by high cumulative inflation, high interest rates. So if you look at the credit card rates, they haven't come down much, even since the Fed started easing. Likewise, auto loan rates. So the defaults are kind of a concern. But all that said, the job market was strong enough. Wages are what determine consumer spending to a large extent. And that gave a pretty good undercurrent of 2.5% type of momentum for real consumer spending going into this.
Right. And as we sit here, and we've heard many different Fed governors and presidents around the country, and Powell himself talk about how the job market still remains fairly strong in the face of the inflationary pressures that have been on the American consumer and the global consumer. And now with the tariff talk, despite what we do and don't see every day in the headlines, the potential down the road is it could add something like $2,000 to spending for most households in the U.S., and which could potentially disrupt their spending power. So how might consumers potentially losing purchasing power infect the way they might be thinking about investing?
Yeah, well, I think if you consider what would happen if the sort of full Monty tariffs, we don't know day to day, it changes like every 10 minutes.
Exactly.
But if they put on the China tariff and the Canada and Mexico as proposed a day or two ago, that could be up to $2,000 per household. And that, I think, translates into about a 1% increase in inflation over the next year, and maybe a 0.5% decrease in GDP. So not enough to cause a recession, but enough to cause a growth scare. And when markets have growth scares, they get bumpy, the equity market in particular, like we're seeing. Investors in that circumstance tend to prefer safer assets. So interestingly this year, just on this scare, bonds have outperformed stocks so far this year.
Yeah.
Investors like to see safer sectors at equity markets like consumer staples as opposed to highly cyclical sectors like consumer discretionary. So I think that's all part and parcel of what could be viewed as a purchasing power shock that this tariff tax hike basically could bring to the economy.
Yeah, and we are seeing that, as you just mentioned. Volatility is not as high as it was last summer. We were just reminiscing last August when the jobs numbers were, significantly different than what we had seen, and there was concern about the state of the economy. It corrected itself within a month, but there was a spike in the volatility index. We see that volatility index a little bit higher, not as high as it was then, but I think it just shows that people are generally kind of concerned about the unknown, those uncertainties in the markets. As we say here, diversify your portfolio and stay in it for the long term if you can, and work with your financial advisor. But that's something that I think is a concern to a lot of folks when you see the way that the markets are trading. And then you've got these sort of higher income households holding significant pandemic era savings, and they're benefiting from that. But some of the affordable brands are becoming even more popular with younger people because they're looking at the higher costs of, like you said, with these auto loan delinquencies. Clearly the payments aren't able to be made considering the loan rates are so high, so they're switching more to value brands, affordable brands. What do you see coming out of this sector, out of this kind of this story that we're hearing?
I think currently, because we've got this two-speed economy, and even consumer sentiment, among the lower income segment is still very depressed compared to much better, attitudes among the higher income segments. You have an opportunity for stores that focus on value products, affordable products, to do well and at least gain market share. Interestingly, our analysts are not convinced that those are necessarily winners, because even if they're gaining market share, if they're actually losing outright dollar sales, they might not do that well as investments. So they're emphasizing diversification and basically trying to focus on finding companies or brands that have kind of enduring qualities that can do well during different types of market environments, and therefore are long-term holds rather than, whoops, we're buying them this week because tariffs are going up. Oops, they're taking away the tariffs. We got to sell them again. So the trading off stories could be pretty volatile or whipsawed easily.
Yeah, you talk about in one of your recent global perspectives to prepare for volatility if you have any Chinese exposure to maybe reduce some of that. Do you see that in any other countries that might be impacted by tariffs? I mean, right now it's only Mexico, Canada, China, but there might be, there's some on the table. There might be a standard tariff across the board that could impact most developed countries around the world.
Yeah, I think what's really tricky about that is I probably should have egg on my face for even writing that, because China is one of the best performing markets in the world this year. Europe is doing tremendously well, even though you'd think, well, these foreign countries are going to get hit by the tariffs. But interestingly enough, what can happen is that the shock of the tariff policy forces them, we just saw in China last night, they're now finally in a very serious way beginning to try to stimulate consumer spending. And of course we had the DeepSeek positive shock for Chinese technology, saying, "Hey, we're right up there with the front line of the world technology revolution,"
which is disrupting some of the tech names here in the U.S.
Yeah, so I think it's really just a classic case, boring advice, but diversification, which is coming into this year, everyone thought China was just going to be terrible and that Europe would be terrible, and they're two of the best performing segments in the world this year.
Incredible.
And the dollar is now down, not up.
Right, and perhaps overvalued is what you say.
Oh yeah, from a long-term point of view, relative to purchasing power parity, it's almost 100% overvalued by the IMF's data.
Amazing. So, Bill, I want to just ask you, for our viewers and our investors out there, what potential opportunities, outside of what we've already talked about, that you are seeing for investors as we kind of go through more of potential uncertainty and probably some decent amounts of volatility over the next weeks, months, maybe even the next year?
When I was looking at consumer sector, talking to our consumer analysts, they had a very simple approach that says, look, there are a lot of companies in the consumer segment that have good management teams, great products, great positioning, but their multiples are just getting crushed because of a fear factor. Those are opportunities. If you believe never bet against the U.S. consumer in the long run, those are opportunities right now. And the policy mix that we may get from the Trump administration is the tough bits come first, but the good bits like the tax cuts and all come later. So if you have the inevitable recovery, those could be real opportunities, right now. The other point I'd make, though, is some of your listeners might have heard of this new index. It's not new, but it's called the Economic Policy Uncertainty Index that some academics out at Stanford put together. And it's right now in the 99th percentile. It's redlining. So you rarely see this amount of uncertainty.
Right.
And their theory is that's bad for the corporate sector because people just sit on their hands and say, how can I invest with all this uncertainty? And it slows the economy. But I did a simple analysis, said, how did the stock market do 3, 6, and 12 months later when this thing redlined into the 99th percentile? Did great.
See?
So never get overly tied up in the narrative of the day, I think, is one of the implications for that.
Right before we sat down today, a friend of mine chatted me on text and said, should I sell out of everything right now and get back in later? I said, no. Stay. Look at the average on the S&P 500, 10% average return since the 1950s. And I think, you got to stay in it to win it. And, I think certainly we're in that place. It feels like you want to get out of everything because there's so much volatility, uncertainty, but, clearly staying in it and working with a financial advisor is key. Bill, always a pleasure. Really, really nice to have you back. Good to see you.
Great to see you, Anthony.
Great.
Thank
Bill Sterling from GW&K Investment Management. And for more on anything coming out of our Chief Investment Office here at UBS and our great partners like GW&K, you can visit our website at ubs.com/views. That's our insights page. Plus, you can take a look at everything that's happening within social media. UBS is on LinkedIn and Facebook. Plus, UBS Studios is on Instagram. You can follow us at UBS Trending. And if you have any questions about what Bill and I spoke about today, we always recommend you speak with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day. And remember to keep your eyes on what's trending. We'll see you soon, everybody.